So that's what we are picking up. Let's now go across to our first guest on the show, Mr. Abhishek, Chief Equity Officer at Intelligence Capital, is now with us. Abhishek, wars are supposed to be one of the times when one looks at buying into the market, or markets traditionally make an important low. But how would you look at this situation? Any people that we're talking to are saying that one has to wait and watch.
Yeah, I would tend to agree. First of all, thanks for having me on your show. You're right, wars or any kind of geopolitical challenges or issues like this, of this magnitude, are an opportunity to definitely look at buying into long-term stocks that you want to. But having said that, on days of extreme volatility like today, for longer term investors, it is better to sit it out, right? You will get your opportunity in a few days, maybe a few weeks. It's better to let, in a sense, let the bloodletting happen in the markets, and then you take a much more calmer view of things and buy into incrementally the stocks that you like.
Right. There are a lot of whipsaws in today's trading session. That's what you meant by heightened volatility, that markets will keep going up, 0.5% plus minus, and you won't even realize. So that's what you want to get away with before you take that call that you were suggesting?
Yeah, absolutely. I mean, see, what happens is when these kinds of tensions are happening, you don't know what kind of statement is going to come from where. Suddenly you will find some global world leader making a statement which will swing the pendulum to one side, then somebody else will come and make a statement. So these kinds of push and pull typically will last for 1 or 2 days. And once that is over, you will know, a lot of the uncertainty is going to get over in terms of the direction of what the event is going to take. Now, what will be the second order consequences? Nobody can predict that right now. Instead of trying to predict that, what we can do as investors is, we have a short list of stocks that we like, or we, have a portfolio of stocks that we bought into. And as and when we get much more lucrative valuations, deploy additional incremental cash in those ideas. So that's what we can do. The best idea is not to, because on days like today, volatility is going to go, like you said, right? 0.5% here, there, 1% up and down. It can continuously happen. It can happen 2-3 times a day, on either direction.
Right. So one, of course, is the point that you were taking with statements coming in, news flow coming in. Second, I just want to point out that MOEX Russia is down 28%. What happens when, such an important market which a lot of investors invest in just falls off the cliff with 25-30%? What sort of cascading impact can it have on other emerging markets?
I honestly don't have a lot of information in terms of what is the kind of investments that are there in the Russian market, especially by US or UK or larger global based funds. My sense is a lot of them would have taken money off the table earlier in the year when things were getting hot, and now what we are seeing is more of knee-jerk reactions for people who are holding on, and also from Russian domestic investors. We will also need to see the volumes that are there that's happening in that particular in Russia in terms of the fall. But these would be typical knee-jerk reactions, right? That would happen in any country if that country has declared war. You will have a first immediate bout of selling because the traders will try to get out of the system immediately because they don't want to take the losses. If you are a long-term investor, you would again want to bide your time to get lucrative valuations that you would want to get into the stocks that you want.
Right. So earlier we were talking about inflation, what's happening with Fed. Of course, all those things don't go away, and of course, with crude going up, natural gas, power prices across Europe going up, only global inflation will rise from here on. What does that mean for the market? Do you think that that's a very important thing which markets are now forgetting because of the geopolitical issues?
In fact, I think personally, if you ask me, that is a bigger challenge in the medium to longer term to global equities rather than what is happening today in Ukraine or Russia. Because what's happening today is probably going to resolve itself in a week, 2 weeks, uh, in a short time frame. I don't think we are in the age of prolonged wars. Uh, but what impact it has on inflation on commodities is going to be more long lasting. Every $10 rise in oil, this was in the recent RBI paper. Every $10 rise in oil prices adds 0.5% to inflation in India. Now, we've seen oil prices spike up significantly in the last 2 to 3 weeks. Now, how that is going to impact Indian economy, Indian markets, is I think something that we need to really sort of be worried about, to be frank, because we are going to get into a stage where the elections are going to, I mean, the domestic elections are going to get over. So I am expecting oil prices to be hiked by the oil companies, and that will again have a cascading effect on inflation. And so all of these are sort of interlinked together, which in my opinion has a bigger role to play in long-term valuations and how we are going to look at equities as an asset class over the next 1 year.
So which are the stocks to buy? The good old Nestle, HUL, Asian Paints, tried and tested names which keep growing 3, 4, 5% every year. You should look at these names, or they provide some safety. A company like Infosys, TCS, would they provide some safety in this falling knife?
First of all, it's always better not to catch a falling knife. But if you have, if you want to, look at companies, I would say, forget about what is happening in Russia and all of this, and look at, take just one step back and see. Q3 results have been reasonably good across the board. We've seen, roughly 22% of revenue growth at an aggregate level. We've seen 14 to 15% of operating profit growth, again at an aggregate level across the industries. Now, what that means is that actually companies are doing well. GST collections have been, doing extremely well. E-way bills are going up. So all in all, it's suggesting that the economy and the businesses are doing better. Now, add to that, in the next 1 to 2 years, we will see a significant amount of private as well as public infrastructure and capex happening because of PLI and other, other schemes that was announced in the budget and subsequently as well. So, in my opinion, I think it's better to look at, the capex heavy industries, businesses, which could be capital goods, engineering, which could be real estate, finance for sure, because credit growth is beginning to pick up a little bit. Quality of credit, quality of banks in terms of their asset book has been, probably in one of the best conditions over the last 10 years. So things are getting better on a fundamental basis in India. And my expectation is that is what is going to play out over the next 6 to 1 year. The next 1 month is obviously going to be very dicey. But if you take a slightly longer term view, I think that's going to be a much better, place to be looking at.
Right. So in capex heavy names, you mean that, with the steel prices, oil prices going up, won't there be an impact, or that is something which you believe this current fall actually captures that?
There will be an impact. Obviously, as and when oil prices go up and things, there will be an impact. But the fact is that if you look at, just as an example, if you look at the PLI schemes in the auto sector, right, we have a huge amount of capital which, in terms of incentive, plus capital which has been sort of committed by the 20 players that have been given the PLI, opted for the PLI scheme. So in the next 2 to 3 years or next 4 years, we will see a significant amount of investment by these 20 companies. Now, how much will they scale back because oil prices have gone through, $100 temporarily. Now, you'll also have to understand, and I'm not an oil expert, but my sense is As and when oil prices go up, you will again have a countervailing, kind of action from the shale oil companies. Also, OPEC is likely to step in because this is more now a geopolitical battle, right? So US is likely to speak to OPEC and they can increase their throughputs and things like that. So macro is a very difficult game to predict. Our job is to look at what is happening in the industries that we are following, what are the businesses that are doing well. Next 6 to 1 year, the underlying economy in India is beginning to pick up. I think COVID is sort of now going to a back burner. People are coming back full scale into back to work. So I am hopeful that's let me put it that way.
All right. But sir, one more thing that, most of the section of the market, especially the new listed ones, some of the companies that were constantly generating free cash flow, valuations had gone out of that. So you think that valuations coming to sanity is something which was needed for the market so that other sectors of value investing can pick up?
Absolutely. And if you see, so one pocket of, one pocket that you mentioned is the IPOs or the new recent IPOs. Most of them were extremely highly valued. A lot of them have corrected significantly. Are they cheap? Still, probably no. They can still, fall further for it to be really making sense to a value investor. But having said that, there are other pockets where, with these corrections, the stronger, older engineering company names or other companies that we've been following, companies which have a long-term track record of performing well, they have also corrected and they are now at a much better valuation than they were, say, 2 months back. So from that perspective, obviously they make much more better investment buys now rather than 2 months back.
Right, sir. Thank you so much, sir, for taking out time for us. Always good to get perspective from you. That's a word coming in as far as the markets is concerned. Also, when we just do a market check, there's been a hint of recovery that's probably come into the markets at this point of time. But we're still at 17,500 level. Taking a break, coming back quickly. Stay tuned.